everyone. Wonderful. Welcome to today's webinar. It's fantastic to have you with us. I think a few people are joining. This is our first time doing this in Teams rather than in Zoom. So I hope we can work together to make this work. Please do type in the chat, introduce yourself, say hello, so that we know who's here. And type in the chat here. Chat is at the top left. Typing there. Please introduce yourself in the chat. The chat is active for you. I'd love somebody to type just so that I have confidence that people are able to type. Oh, hello, Sarah. Welcome. Sarah's typing. Brilliant. Is there somebody, a participant who can chat, sign in the chat so I can have confidence that that's working? That would be great. If not, we need to adjust the settings. Can somebody type there? Oh, if there's anybody in the room who knows me and could WhatsApp me if you're having trouble typing in the chat, if it's not possible, then I need to know that. There's also a Q&A function for questions. Okay, well, I think we'll get started, and if there is a problem with the chat, we will solve that as we go along. Super. So without further ado, welcome to this first in our series of webinars for Exposure Draft 3 of International Non-Profit Accounting Guidance. My name is Samantha Musoke. I'm the project director, the IFR for NPO project director with Humentum, and I'm delighted to be joined by Sarah Sheen, who is a technical associate, with CITFA, the Chartered Institute of Public Finance and Accountancy, and has been on the technical team drafting the content that we're covering today. So Sarah, really delighted to have you with us. Oh, I can see somebody's typed in the chat. Super. So we have a multilingual webinar today, and I'd like to explain to you how to activate the captioning. So we'll do that quickly. If you'd like captions or translation, click on the 3 buttons with the more at the top, then click language and speech, then turn on live captions. Once you have captions, you should see it at the bottom of your screen, and there's a little cog for the settings. You can click settings, and then you can change the caption language to Japanese or French or whatever you would like. Please do not change the spoken language, because that will change it for everybody. Brian, if you wouldn't mind sharing the link to the Word document that has these instructions on as well, you need that. So that is a Word document that has these instructions for how to do the captions and the translation. Now we can also translate the chat. So if you hover over any message in the chat and click the 3 buttons, I would do this even if you're an English speaker, because it will enable other people who type in other languages. It will enable you to read them in English. So click on the 3 dots as you hover over a message, click on translation, and then settings. You get to this section called appearance and accessibility, and you need to scroll down to the section that says language and translation. And then you have the option, and you can auto translate all messages into your chosen language. So please feel free to type in the chat in any language. In the Q&A, please only type in English. So without further ado, let's get started. If you have a problem, please do type in the chat and hopefully we can help you. So today is the first in our series of 5 webinars, and we're going to be looking at the proposals for the classification and reporting of expenses in INPAG, as set out in Exposure Draft 3. The whole goal of sharing these proposals is so that you can share your feedback. It's an exposure draft, which is shared for public comment precisely so that you can tell us your thoughts and so that we can make sure that INPAG is fit for purpose in all the different contexts that we hope it will be applicable. So the way the session will work today is that we have the 5 minutes of introduction, which we've basically just had. We're going to show a pre-recorded video. We'll show it in English on the screen here, and we'll share the link so that you can watch it in Spanish or French from YouTube. And then we'll have a Q&A session, and then finally we'll wrap up with how to respond. I hope that this is going to work and it's working in the chat. Yes. Okay, so with that, the explainer video, as I say, we're going to play it in YouTube. If you go in the chat, there'll be a link there to watch the same video in French and Spanish. Now, if you're watching in French and Spanish, you'll want to turn off the audio from our Teams meeting. Otherwise, you'll be hearing the English version at the same time as your other one. And to do that, again, you need to go to the 3 dots and click More, go to the audio settings, and turn your speakers off. Then watch the video in YouTube and then come back to Teams and turn your audio back on so that you can hear and join in the Q&A session. Hope that all makes sense. It'd be great to have a thumbs up or a reaction or something, because I'm not really getting much of knowing how people are feeling about this and whether they're following what's going on. So if anybody could give me a thumbs up type reaction or something like that, that would be very helpful. Seeing anything? Well, let's go ahead and play the video and we'll take it from there. Here we go.
Information about an NPO's expenses in general and fundraising costs in particular are important to users of general-purpose financial statements. This video explains the proposals in INPAG Exposure Draft 3 for the classification and reporting of expenses. It will cover the analysis of expenses by nature, function, or a mixture, and outline the cost allocation principles to calculate direct, shared, and support costs. We will explain the presentation and disclosure requirements for expenses, and touch on the treatment of capital expenditure. We'll also describe the proposals in relation to personnel costs and fundraising costs. Guidance for the classification of NPO expenses is found in INPAG Section 24, Part 2. In recognition of the diversity in the sector, there is flexibility in the options for presenting expenses. NPOs may provide an analysis of expenses using one of 3 classification approaches. It can be based on the nature of expenses, the function of expenses within the NPO, or a mixed presentation that combines parts of the nature and function of expenses approaches. Where expenses are classified based on their nature, the analysis shows the inputs that an NPO uses for the activities it carries out to meet its mission, such as paying for staff, premises, or travel. An NPO must show the categories of spend that provide the most relevant and reliable information to the users of the NPO's financial statements. The example shows what an analysis of expenses by nature may look like and includes typical expense items, such as staff costs, rent rates and utilities, medical supplies, and grants made. Where expenses are classified by function, the expense analysis shows the cost of the activities that the NPO has carried out. A function of expense analysis might show major programs such as education and counseling services or research and development or administration activities. To produce an expense analysis based on function, an NPO must allocate and combine expenses according to the activity to which each function relates. Where an NPO chooses to present an analysis by function, it is necessary to provide a narrative description of the material types of expenses which comprise each activity. NPOs don't need to disclose the amount spent on each type of expense with this description, just the nature. In this example, the analysis shows the cost of its activities on education and counseling services, research and development programs, fundraising activities and support activities. The analysis of activities and programs should provide information that is the most relevant and reliable to the users of the NPO's financial statements. For this example, the types of costs included within educational activities is provided in a narrative description as shown. This would also need to be provided for the other functions presented. A mixed presentation basis is where expenses are classified in part by nature and in part by function. This will see some expenses presented by type, but other transactions allocated and aggregated according to the activity they relate to. Where an NPO chooses to present expense items using a mixed presentation, a narrative description of the material expense types within each functional activity must also be provided. Here is an example of an analysis of expenses using a mixed presentation. It includes an NPO's costs of providing test kits, which is relevant in this case because they expect to recover the cost from service users. In this example, the NPO also carries out other activities which are better understood by the inputs and therefore staff costs, premises costs, and depreciation are shown separately for these. The use of classification according to the functions or nature of expenses should provide the information that is most relevant and reliable to the users of the NPO's financial statements. A narrative explanation is provided to describe the material expense types of each of the activities in the functional element of the presentation. Although NPOs are permitted to choose the classification method, the proposals also include a rebuttable presumption. The presumption is that the most relevant and reliable information for users of the financial statements will be provided by a nature of expenses analysis, so this is the default. However, an NPO can form a judgment that the default analysis by nature of expenses will not provide information that is more relevant and reliable to the users of its financial statements, and instead choose a presentation based on functional or mixed classification. In this case, a note must be provided to explain why the alternative analysis provides information that is more relevant and reliable to the users of the financial statements. In making the judgment about which classification to use, an NPO must consider a number of factors including which method is more relevant and reliable. For example, where an NPO generates surpluses from retail activities, which it uses to fund its missional activities, reporting a cost of sales line item might be more relevant and reliable. In this case, a functional analysis might be most appropriate. Which method represents the way in which the NPO is managed? Where an NPO is managed according to its programs of activity, such as emergency response and educational programs, a more relevant and reliable way of presenting these costs might be a functional analysis. Sector practice. Where a sector or a particular type of NPO normally uses one form of classification, consistency may enable comparison of expenses of different NPOs within that sector, as well as providing the most relevant information. If allocation of expenses to functions would be essentially arbitrary, then it would not provide reliable or relevant information. Whichever classification method is used, NPOs can choose to present the information either on the face of the statement of income and expenses or in the notes to the financial statements. INPAG provides guidance on the allocation and aggregation of expenses. This will be needed where a functional or mixed classification of expenses is used. It may also be needed to calculate fundraising costs or to calculate support costs where supplementary statements are prepared in accordance with INPAG Practice Guide 1. Methods need to be reasonable and consistently applied to all activities, and also be consistent between reporting periods unless circumstances change. Methods selected must also ensure that the accounts faithfully represent the costs of activities. Section 24, Part 2, provides general principles that need to be followed by an NPO when allocating expenses. It identifies costs as being either direct costs, shared costs, or support costs. A direct cost is a cost that is only for the purpose of a single activity. It can therefore be directly attributed to that activity. For example, the staff costs of an individual employee who works only on one project are directly attributable to that project. All of the staff costs of that employee must therefore be allocated to that activity. If that individual employee spent half of their time working on one project and half on another, their staff costs are still directly attributable, but they need to be allocated between the two projects. In INPAG, these are referred to as shared costs. Where there are shared costs, a suitable basis must be applied to allocate the costs to the relevant activities. In this example, time spent by the employee on each project would be a suitable basis. For running costs of a vehicle used by more than one project, the distance driven for the purposes of each project might be a more suitable base. Support costs are those costs incurred on the activities which are necessary to administer and manage the NPO as a whole. For example, the staff costs of an individual that works on governance issues that are necessary for the overall functioning of the NPO. Support costs relate to all the activities of the NPO, so they cannot be directly attributable to an individual activity. For example, an NPO may decide that costs related to governance should be apportioned to activities, based on the percentage of the NPO's operational budget those activities comprise. This example demonstrates these general principles. An NPO rents an office building for $1,000 per month. Monthly rent is allocated to the NPO's activities, based on floor space occupied as follows. Rent is allocated to an activity for the space occupied where staff are working directly on an activity. These are shared costs that are allocated based on the area of space occupied by each staff member or team. In this example, 25% of the floor space is occupied by staff working on activity A, and 25% is occupied by staff who work on activity B. As a consequence of charging the rent costs to direct activities, $250 is charged to activity A, and $250 is charged to activity B. The remaining 50% of the floor space is used by staff carrying out support activities, so $500 is charged to support costs. This cost is then apportioned to the direct activities, based on the respective operational budgets. Activity A is 20% and activity B is 80%. Therefore, 20% of $500, that is $100, is charged to activity A, and 80%, which is $400, is charged to activity B. Other sections of INPAG require the disclosure of expense information. For example, Section 17 on property, plant, and equipment requires the disclosure of the annual depreciation charged. In developing INPAG, it was decided that if expenses information is required to be disclosed by another section of INPAG, it should form part of the disclosures related to that section, and it does not have to appear in a separate disclosure note about expenses. However, there are two specific disclosures included in Section 24, Part 2. Firstly, benefits to volunteers, such as free or subsidized services or goods. These must be disclosed separately. This applies to all volunteers, except where a volunteer is a related party. Where this is the case, any benefits must be reported under the related party disclosure requirements. Secondly, losses, write-offs, and special payments. These must also be reported separately. These might be cash losses through fraud or theft, or where there have been unrecoverable overpayments, which have to be written off. Special payments might also include payments to contractors outside of a binding contract, compensation payments, and severance payments. In some jurisdictions, it is common practice for NPOs to expense grant-funded assets. It is worth noting that in INPAG, all material additions of property, plant, and equipment that meet the definition of an asset in Section 17 are capitalized, irrespective of the source of funding. Section 17 of INPAG also requires depreciation to be charged to the statement of income and expenses. Depreciation is charged to the same fund as the asset. For example, if there are restrictions on the way the asset may be used, the asset would be part of fund with restrictions. For purposes of reporting to donors, the standard format in INPAG Practice Guide 1, Supplementary Statements, includes the option to remove depreciation and show capital expenditure, which is a preference for many donors. Further information can be found in the videos shown. The links are in the description below. The cost of employees is often significant for NPOs. It is a cost that attracts interest from users of the financial statements. The inclusion of employee costs was discussed with advisory groups, and there was consensus that these should be disclosed. Following the principle to disclose expense information alongside other relevant information, Exposure Draft 3 includes an amendment to the disclosures of short-term employee benefits, which was included in Exposure Draft 2. There are also some amendments to the disclosure requirements for related parties. For short-term employee expenses, INPAG now requires the separate disclosure of the following costs: wages, salaries, and social security contributions, non-monetary benefits for current employees, such as medical care, housing, cars, and free or subsidized goods or services, other than those provided on the same terms as other eligible service recipients. Bonuses paid within 12 months after the end of the reporting period in which the employees render the related service, and other staff-related statutory or contractual costs. When considering related party transactions, a small number of changes are proposed to the disclosure requirements, and the types of transactions have been broadened to include grants and donations. A new requirement is proposed to disclose compensation to governing body members. Governing body members are individuals that have responsibility for oversight of the NPO's activities, whether or not they are paid. These persons might also be described as trustees or board members. The disclosure includes all forms of personnel compensation benefits, with the same scope as Section 28 for employee benefits. This includes whether the payments have been made by the NPO or on its behalf. The legal basis of the personnel compensation paid must also be disclosed. The following disclosures are required in the notes to the financial statements. Either none of the members of the governing body have been paid any compensation or benefits from their work with the NPO, or one or more of the members of the governing body has been paid compensation or other benefits from employment with the NPO. If compensation has been paid, the following disclosures are required: who was paid and the nature of the work they were paid for, the legal arrangement for payment, and confirmation that the NPO is allowed to make such payments under the law or in accordance with the NPO's constitution. The amount paid must be broken down between salary, pension, and other benefits. In addition, where governing body members have claimed expenses, the NPO will need to disclose how many members have been paid and the value of any material expenses paid, disclosing their type or nature. There are two exemptions for the disclosure of related party transactions for governing body members. A grant or donation made by a member does not need to be disclosed, provided there are no special obligations to amend an NPO's normal activities, such as the use of certain suppliers or sources of inputs. All enforceable grant arrangements will need to be disclosed because they impose specific performance requirements on the NPO. Also, services received by a governing body member do not need to be disclosed, where they are received on the same terms as any other eligible recipient. INPAG includes separate guidance on reporting the cost of fundraising. These proposals are included in Section 24, Part 3. The proposals have been developed to provide a more transparent approach to reporting fundraising costs. INPAG requires that fundraising costs are separately reported, whichever classification of expenses it uses. It also describes 3 categories of fundraising costs and how they are to be calculated. INPAG describes fundraising costs as including donations, gifts, grants, and similar transfers, commercial and trading costs, and the cost of investment management. The cost of fundraising excludes the development of documents applicable to the whole of an NPO's activities, such as the cost of business plans or annual reports, or even websites. The first category of fundraising costs is activities to obtain donations or gifts, or to win grants, from entities or individuals external to the NPO. Examples of such expenses include the costs of the following activities: seeking donations, grants, and legacies, operating membership schemes or social lotteries, staging events, contracting with agents to raise funds on behalf of the NPO, researching and developing fundraising strategies and plans for prospective donors, and advertising and marketing, provided these do not relate to the NPO as a whole. The second category of fundraising costs relates to commercial and trading activities. These will be from activities being carried out specifically to generate funds to be used in meeting an NPO's primary purpose. They could relate to operating a trading outlet to sell donated or bought-in goods, or operating a trading company undertaking other commercial or trading activities. Some NPOs make a charge or expect a contribution to partially cover the costs of services or goods they provide as part of their primary purpose. The costs associated with generating income in this way are not fundraising costs, as they are part of the NPO's operating model. The third category of fundraising costs relates to the management of investments. This applies to investments held specifically to generate financial returns. For example, an NPO may receive shares that cannot be sold, but the returns from those investments can be used for the NPO's missional objectives. Fundraising costs in the investment management category include, but are not limited to, portfolio management, obtaining investment advice, administration of the investments, costs of licensing intellectual property, rent collection and property repairs, and maintenance charges for investment property. To calculate fundraising costs, NPOs may need to allocate costs to each of these activities. INPAG requires the use of the attribution methods identified in Part 2 of Section 24 for the classification of expenses. This means that fundraising costs will be comprised of their direct costs, shared costs, and support costs. For commercial and trading activities, fundraising costs must include all costs to sell donated or commercial products. This will include those costs associated with the direct production of goods or services, shared production costs, and any support costs. For investment management costs, where investment managers deduct their fees from any investment income, the NPO should report the gross investment income before fees, and then report the management fees charged as a cost, where this is possible. Sometimes activities serve multiple purposes beyond just fundraising, such as also raising awareness about the work of the NPO. INPAG requires that where there is more than one purpose, that the costs should be split. It does, however, include a pragmatic exemption. A split is not required, where the costs of calculating the split are greater than the benefits to the users of the financial statements, of reporting the costs associated with the fundraising aspect of the activity. Costs relating to each of the fundraising categories must be reported separately. All fundraising costs must be reported on a gross basis, and not be netted off income. This requirement follows the general INPAG requirement that all transactions must be reported on a gross basis. The disclosures must include a narrative description of the method of cost allocation and basis of apportionment adopted to estimate fundraising costs. Where the pragmatic exemption related to the splitting of costs has been used, it should be reported in the disclosures. Where useful, an NPO may present an analysis of revenue raised with the costs of the associated specific activities, provided that the costs are presented gross. This video has explained the INPAG proposals for the reporting of expenses in Exposure Draft 3, including fundraising costs. Expenses analysis is to be presented using a classification based on the nature of expenses, unless this would not provide the most relevant or reliable information. In these instances, NPOs may use an analysis using the function of expenses or a mixed presentation. INPAG provides guidance on the allocation and aggregation of costs through attribution to direct, shared, and support costs. This ensures that the accounts include a relevant and faithful representation of the costs of activity. The analysis of expenses may be presented either on the face of the statement of income and expenses or in the notes. There are specific disclosures related to the reporting of benefits received by volunteers, as well as losses, write-offs, and special payments. There is also additional guidance relating to personnel compensation, including consequential amendments to related party disclosures. The reporting of fundraising costs has been set out, according to 3 distinct categories: donations, gifts, and grants, and similar transfers, commercial and trading, and investment management. We very much look forward to hearing your feedback on the proposals in Exposure Draft 3. To respond, visit www.ifr4npo.org/haveyoursay. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 16th of September, 2024. Information about an NPO's
Unmute. Super. So there we are. I'm actually going to, I think, stop sharing my screen now, because I'd love us to go into a session of Q&A. It's quite a fast delivery there, and I'd love to hear your feedback on the video as well. We've used this AI talking head situation for the first time, and I'd love to get your ideas on how you found that. But separately, we've got some great questions. If you want to ask a question in English, please put it in the Q&A, and you can thumbs up somebody else's question, which is really helpful because then it will go up the list and we can make sure we address the most popular questions. If you'd like to put a question in French or Spanish or another language, put it in the chat and Brian will transfer it to the Q&A, or we'll find a way of addressing it. Super. So Sarah, this has been quite a challenge, this section, hasn't it? I think it's been one of the hardest, and it's one of the reasons why it's ended up in exposure draft 3 rather than 1 or 2, because it has been a challenge to this nature and function and a lot of these issues. So first question is relating to support costs. And as we know, support cost is an example of a functional expense. We've got various allocations and things like that. So Charles's question is, does INPAG provide a recommended basis or broad principle for allocation of support costs? And I guess this is this a rules-based or is this kind of principles-based? Is this something that can be consistently applied across every organisation, or is this quite high-level principles-based? Over to you. Can you unmute though first? I could see you about to launch. Aha, there we go.
Good spot. Well done. Thank you, Sam. And thank you for inviting me along today. It's really brilliant to be here. It's a simple answer is no, there's not a direct way, because support costs could be allocated and should be allocated in accordance with an NPO's own functions, and what is right for one NPO won't be right for another NPO. So it is very difficult to give overall guidance. There are principles based in there, and it should be fair, and it should be a reliable and representative allocation of costs. So those principles are baked into the guidance, but there aren't any prescriptive ways of doing it. There are examples, and there are examples we've shown in the video as well, but there's no prescriptions, because, as I said, what might be right for one NPO is not very likely to be right for different types of NPO with different structures. Ooh, you're on mute now, Sam.
My turn to be on mute. So it's quite principles based, quite high level. And that links, I want to ask a question that Mark put, which is what happens if you want to make changes to the way that you do your allocations according to activities? Would it be similar to like a change in accounting policy? Is it that rigorous? Or because it's a bit more internal and usually it's an internal matter rather than an external matter, how easy is it, and how can you change your approach to calculating support costs or any kind of activity allocations?
That's a very good question. I'm going to have to think about that. It's borderline, I think. I would err on that it's a change in accounting policy, but I will have to get back to you just to make sure it's not an estimation basis.
So you've got a good question there, and that's really going to be important, because sometimes the realities change, but then you don't want to be changing just for the sake of it to make the numbers look different. So let's see. That's a great question. We'll come back to you on that one. Thanks, Mark. Now, there's a question here from Margaret, which is, will this treatment of grant-funded assets be retrospective? So this is the idea that if I've got a restricted asset, it sits in the fund. And I know for many of us, this idea of having fund accounting is more linked to the income and expenditure, the P&L side of things, rather than the balance sheet. And we're not necessarily used to allocating assets and liabilities to funds. So this is quite a big deal, because if we've got assets that are, tens of years old, grant funded, restricted use, but long life, do we have to, is that retrospective? Are we going to have to go back and look through our whole asset register, identify what's restricted and allocate it to funds? Great question.
Again, I need to check the transitional provisions again. One would assume that it has to be, otherwise you're not reporting your restricted funds properly. If it is a part of the restricted funds, then it needs to be fully retrospective and allocated. I don't think that there are any transitional provisions in relation to that, but I haven't looked at that in detail recently, so I'd need to get back to be absolutely clear. There's no if it's going to be anywhere, it will be in the transitional provisions. That's in section 38. In theory, it would have to be, general accounting would say that you would have to put it in there, otherwise you're not reporting your funds properly and you're missing elements of the funds out of there.
Okay, so there is going to be another webinar on transition arrangements. Well, it's on other topics in ED3 generally, and it will include those transition arrangements, which Karen Sanderson, the technical director, will be addressing. So maybe we can make sure and re-raise that great question in that webinar as well. Now, Mark's question I thought was about support costs and allocations, but it isn't. Let me get it right. It's about general classification, whatever approach you use. So say you use natural, or you use functional, or you use a mixed. If I want to change that year on year, how much flexibility is there over changing that? Is that an estimation, or is that like an accounting policy? If I wanted to change,
definitely an accounting policy. I'm very clear on that one.
Okay.
And I think that I think probably support cost allocation is as well, but I would just want to be absolutely sure on that. So, but classification is definitely an accounting policy choice, and if you're changing it, you would do that retrospectively.
Good. Okay. Thanks for Mark for that good question. And sorry I asked it wrongly the first time. There's a comment from Jenny about the challenges of allocating assets to restricted and unrestricted. It really is quite onerous from an accounting system point of view, and many accounting systems aren't really set up to do it. So I just love your feedback on your thoughts about the onerousness of it. Obviously, this is targeted at the small and medium sized NPOs. We're not trying to you shouldn't have to need a massively, hugely expensive accounting system in order to apply INPAG. So what are your thoughts on that allocation of assets to funds in that context?
I think again, it's my same answer is that if it has a significant effect and it's a material asset to for a fund, then the fund, to be fully and properly reported, it would need to be included in each relevant fund where if it's restricted to, particularly where it's an important part of the funding obligation. So to do a fund accounting properly, I think it has to be a full part of the picture. That's not to say we can't underestimate that there's a lot of work in that, and I think with it there will need to be thoughts about how best to garner and create the right management information to support fund accounting. I think INPAG's been written at the level to be as both useful as possible, but taking into account the impact on the size of body INPAG is directed to. So yes, it probably is onerous. It probably is quite onerous to set up, but it should, at the same time, promote accountability and transparency for all stakeholders, including for donors.
I know that many organisations, or if they keep a fixed asset register, will indicate whether there are use restrictions as one of the columns on their asset register, asset ABC, and these are restricted or not. So sometimes that information is available. It's really the accounting is more sort of tricky. I know that I have got accounting software providers knocking on my door. I get emails from them all the time wanting to know what are the requirements of INPAG and how can we make sure our systems work for it. So I think probably, Jenny, the longer term and hopefully not too long term answer is that the onerousness of the accounting, which I think is undeniable, can hopefully be managed by accounting software, especially this fund accounting piece. It is difficult. You can't do fund accounting if you've got nothing but an Excel spreadsheet. And we need to have software that can help us do that. So hopefully once it's into a recognized international standard way of doing things, it will be easier for software to align and help us to do that. So that's my hope. But it's a really important point you've raised. You've also said some funders fund depreciation rather than capital costs, especially for shared assets. So say I've got, you know, office assets, and the funder will consider depreciation as part of, you know, part of its covering of support costs. What's the proposed treatment if an asset is covered, if a donor will pay for the depreciation? I guess that links more probably to our webinar tomorrow. So I might just sort of preempt that a little bit rather than put it to you, Sarah, which is basically you've got a choice that you can keep the depreciation in the fund and charge that to the donor, or there's the option to pull out depreciation and show capital costs. So it's not a requirement to do it one way or the other. There's the option depending on what your funder needs. Okay, let's move on. So here's a question about the personnel remuneration. It seems a bit intrusive. Does it apply, for example, to a CEO who attends the board but is not a trustee? Does that mean that the CEO's salary and benefits need to be disclosed in the financial statements? Maybe Margaret is a CEO. But anyway, any CEO would be interested in knowing the answer.
If they're not a trustee and therefore not a member of the governing body, then the governing body member disclosures don't apply. That being said, I think generally in lots of regions and in lots of different sectors, CEOs pay is disclosed. So it's not something that would be unusual anyway. It is a requirement, for example, the Companies Act in the UK. So, you know, it's not an unusual thing for CEOs' remuneration to be disclosed. That being said, in this case, in this particular example that I read in there, if they're not a trustee, then they're not covered by the governing body member disclosures. If they're not a governing body, if by not being a trustee, they're not a governing body member, which is, I'm assuming, what Margaret's question is aimed at.
Okay, so that if they sit on the board of trustees as a sort of observer, or as a secretariat, rather than having a sort of vote, then the governing body disclosures don't apply. But nonetheless, senior management personnel, CEOs, this is an area that has, nobody likes it, but it's a disclosure that people are interested in businesses, in non-profits. Nobody likes it, but this is something that you should take a close look at, and maybe we'll need to clarify that as well, exactly what would be required.
It's interesting. Okay. It's often one that the users are more interested in than in lots of other parts of the financial statements.
Yeah. And unfortunately, that's this kind of debate about support costs as well. You're spending too much in support costs. Well, this is how we run the entity and make sure it's safe and functioning. So you have to justify those costs, and that's always a challenge. But there we are. So this is from Chifula, Alicia. What steps can be taken to guarantee that the financial reports are easily understandable and thorough, giving stakeholders all the information they need to evaluate the nonprofit's financial health and performance? What a question. This is like, you know, how do we, this is like what the whole project is basically, how to make sure they're understandable and yet thorough, and can give a big picture. Now, again, I'm not going to throw this to you, Sarah, because the week after next, we have a webinar called Illustrative Financial Statements, where we're going to go through the illustrative financial statements that are part of the implementation guidance in INPAG, and kind of show the big picture and how we're trying to get that balance of understandability and thoroughness, how you can get a picture of financial health and performance. Performance is an interesting word. But that's another webinar. So I'm not going to put that to you, Sarah, if that's okay.
Although I would say doing INPAG is a good first step. So it is a way of actually achieving those aims, I think.
Yeah, absolutely. That's why we're here. That's what we're trying to do. Absolutely. That is the goal. And if you've got feedback that says you don't think we're meeting that goal, that's what we want to hear, because that's what we're trying to do. That's it. Okay, Mark. Sarah, you gave an explanation about why there'll be no guidance on the allocation of support costs to be set out in INPAG. I'm not sure that's quite right, because there is guidance, but it's quite principles based rather than rules based. What I do know, and there have been calls for, we have been asked to consider a practice guide, which is a more rules-based practice guide on support costs and their calculations, so we can get more consistency If that does go ahead, it will be after INPAG is published in 2025, and that will be part of our next stream of work. And we'll have a big discussion about whether rules would be appropriate and what rules they should be, so that we can get more consistency. There's always a trade-off: principles, rules. And generally INPAG is rules-based, but the practice guides are, generally INPAG is principles-based, but the practice guides are a bit more rules-based so far. So that is one to watch. Lawrence, could the change in allocation method create a prior period error instead of a change in accounting policy? Like a prior year adjustment, I suppose.
I mean, a prior period adjustment would be the same kind of accounting treatment as a change in accounting policy. So it would be the same result. If you're changing your, so that's why I think it probably is a change in accounting policy. So no, it wouldn't be an error, unless of course there was an error in the system that did it, which is always a possibility. But if it is just a change because you've seen a better, looking at the NPOs facilities, there's a better way of doing it. You've found more information. There's better improvements. Then that's not an error. That is either that's a change in accounting policy. That's because you found a more useful way of presenting that information. So that's not an error, unless there are often errors in systems that might do it. That would be different.
Okay. Good. Now, here's linked actually. So Soleil has asked, change of presentation or methods applied retrospectively may need to affect on IFRS the OCI, the other comprehensive income. In the present case of INPAG, what would equate to the OCI? What do we have in INPAG that those of us who know IFRS call the statement of other comprehensive, or the section that covers other comprehensive income?
I think this would be one for the financial statements one, which explains that we don't have an OCI in this, and there's the fund movements information, but there's not a separate OCI reported in this in the INPAG statements.
Great. So we'll cover that again in a future webinar in a bit more detail. Great question here from Nato. Could you clarify how to distinguish fundraising costs from costs associated with earning specific funds or revenues? For example, when are investment property management fees considered fundraising costs, and when are they costs associated with earning rental income? One could argue that fundraising costs are only those expenses incurred well in advance of generating funds, and where the amount or probability of generating those funds is uncertain. What's your take on that, Sarah?
I don't think it necessarily is a time limited thing. I think it is based on, if it is a cost of generating earnings, then that's not a fundraising cost. It is the investment management expenses. It is the person going to make sure that the investment property is properly managed. It is the list of the things that were on the presentation. It's not necessarily things that are actually create the earnings within the funds themselves. So that I think is a distinction.
But Sarah, if an NPO has property, and it generates rental income, isn't the cost associated with collecting that income and managing that property and all that, those are part of what we're calling fundraising costs, right? And it's a bit counterintuitive because, and again, many debates about this, and we put it to a focus group, because when I think of fundraising costs, I tend to think of, grants and donations and that kind of fundraising, going out with the shaking tin and doing sponsored events and whatever. So we've got a broad definition of fundraising costs that includes investments, things like property where you're getting rental income, and includes commercial activities as well. So this is a bit of a paradigm shift. So rather than having quite a narrow definition of fundraising costs, it's costs associated with raising funds in a fairly broad sense. So I think that question is probably highlighting that this is quite a paradigm shift and quite a new way to define it for a lot of people. Would that be fair, Sarah?
It is a wide, it's not something I would intuitively think of as fundraising costs, but it is a part of supporting the fundraising abilities of an NPO, and investment management costs are different. And I think there might be a fine line with all these things. And so you would have to be very, and particularly probably around investment management costs is where you'd need to be very careful around that definition to make sure it's in the right place. But certainly that would be one to make sure, it'd be really helpful to get that response in the consultation analysis, consultation responses, so we can make sure that it's clearly defined, or as clear as possible, because I think there's always an element of decision and judgment about these things, but as clearly as possibly defined when the final guidance is produced. So it'd be really useful to have that kind of feedback to make sure we're clear that the wording in the INPAG actually puts as clear a line as possible in between those two things that you were mentioning.
Great. I'm going to go to Mohammed's question. Now, he's saying some NGOs have a lot of projects, like maybe 180 projects, let's think, just pick a number, like lots, big. It's not possible to allocate the mixed costs according to activities or project-wise, and it's also not possible to maintain a project timesheet. What will be done? At present, they are charging ICR to projects, indirect cost rates to projects. So rather than each person filling out so if you're somebody who works across the organization, like a shared cost, maybe you're the finance director or something like that, you can't put some of your time to project A and some of your time to project B and some of your time to project C. It doesn't work like that. You're working on the audit for the whole organization or whatever. So you're quite right. It would still be the cost of me as the finance director would be a shared cost, just like we had earlier. We had that example of that the rest of the rent was considered a shared cost, and it was allocated on an indirect cost rate basis. So that would still apply. If you've got shared costs, even staff costs, whatever they are, you can allocate them or apportion them to projects according to whatever basis you use. It doesn't have to be, each sheet used on the photocopier assigned to a project in that kind of way. You can still use ICR. That's right, isn't it, Sarah?
Well, I would assume that the FD, for example, in most cases, because they manage all the functions and not attributable to any particular project, unless they do, there is always a possibility that they may spend 75% or 25% of their time on project A. Sorry, I'm so used to seeing project A and project B, a specific project, that they may allocate or attribute directly their costs to one particular project. But most of the time, for example, I would expect FDs to cover all functions of an NPO, and therefore would use an appropriate allocation of support service costs. And if that allocation is taking place in an appropriate way currently, there's no absolute need to change that. I can't see that you'd need to do any other apportionment basis. So provided it is a fair, proper representation of the costs across the various activities, which it already appears to be being doing, then is unlikely. I don't know. I wouldn't say categorically to be a need to change that, but I'm not as au fait with that method of support service allocation as you are, Sam. So I can't see it.
Yeah. So when I was an FD, not so many years ago, I had a project. I had a line on my timesheet for a particular project that I spent a lot of time on, that was bigger than everything else and really had dedicated time. And I had a line for shared, and the shared line became part of the overheads, which was allocated. Now, one thing that I think is really important here, whenever we talk about indirect costs, is the distinction between the revenue that I'm getting from my donor. Maybe it's 10% of direct costs. That's the income that's coming in, which is a really different thing to the costs that I'm actually incurring. And that's something that I think will come up in another webinar as well. But the income that you get from your funder is a totally different thing from the actual costs that you're really incurring. And what this webinar is about the actual costs. Great. Okay, we're running. There's so many great questions here. like, and we've got like 1 or 2 more minutes. So this is a good one from AJ. What is an acceptable percentage of support costs with regards to program costs or funds raised? How much support costs is too much?
I don't think there is a definition of that, and there doesn't need to be. It is whatever is relevant for supporting the NPO. Now, there are probably political commentaries around that, but in various regions, because as Sam mentioned earlier, the support costs and the impact of support costs is a huge issue for all NPOs, and the commentaries, but there is no acceptable definition. It is whatever it is relevant. It's not what financial reporting isn't doing is measuring what's acceptable. It's measuring what it actually is.
Right. And I know that research that's been done by Humentum has shown that it varies greatly by size. So the middle-sized organizations have the highest rates because you've got to invest in some of the infrastructure, and yet you don't have the cost base to make the percentage lower. And there's a lot of discussion in the research that we did in Humentum. Most found that they were basically underfunded for their support costs. So I'm not going to give a figure, and we, as Humentum, are desperately going to try and fight and make it clear to readers when we do all our education about helping readers to read financial statements. It will be big trap. Do not say this percentage is higher than X and therefore it's too high. It's one of the easiest traps to fall into, and it's very unhelpful. So I'm really glad you asked that question. We've got 4 minutes left, so I think well, maybe we can fit one more question in because the rounding up is very short. Oh no, I think we are going to. Thanks for the other questions. We will have a look at. I think there's 2 more there, but I'm going to share my screen so that we can finish on time and respect your time. So as I said, thank you. These have been great questions, some of which have us got us scratching our heads as well, which is exactly what we want. The whole point is so that you can share your voice and have your say. To do that, you go to the project website, ifr4npo.org/have-your-say. You download a response template. It's in English at the moment, but I am planning to add it in French and Spanish. I just realized that yesterday. Save it with a file name that's got your name, you know, INPAG ED3 response. Spend some time forming your opinions. I'm sure even today, hearing the questions, hearing things that people have asked, hearing the answers, it's making you think the things that you care about and the things that you like or have concerns about. Watch the videos, read the documents. Step 3, record your thoughts into the template. The template has different sections with questions and a box where you can put the answers. There is another section at the bottom for anything else. We have, I think it's 37 specific questions that have been put, but you don't have to limit it to those, and you don't have to answer all of them. There's a section at the end, and if you want to just write a letter, you can, but please make sure it's clear which section you're referring to so that we can analyze it properly. And then you upload it via the website before the 16th of September. So, I mean, yes, that's right. Now, what happens to all your responses? They don't just go into a black box. We analyze them. We discuss them, debate them. We will be putting things to focus groups that we've recently set up. We're going to go to the practitioner advisory group and the technical advisory group to hone and consider. And all those meetings, not the focus groups, but the advisory groups are public, and you can see what happens with those. And the idea, not the idea, we will be publishing INPAG next year. I will say mid. I won't put a date on it, but that is very much the plan. It does rather depend on the complexity of the responses. So please visit the website. You can sign up to our monthly newsletter. We have a new page, a support us page, where you can show your organization's logo or just your name to say that you believe this is a good thing. Doesn't mean you agree with everything in INPAG, because we're in the process of fine-tuning and tugging and changing. Join us on LinkedIn, register for more events. There's more webinars this week. Tomorrow is INPAG and donor reporting. Thursday is fund accounting. So please do register for those. And then the week after next, we've got other topics and the illustrative financial statements. We've also got some great blogs and articles. So with that, let me say a huge thank you to Sarah and a massive thank you to all of you, all 100 plus of you, for your time, for your great comments, for your wisdom and challenges. It's been super. We're really, really, really grateful. So have a great day. Please, if you have any comments, let me know. And I look forward to hearing from you and seeing you hopefully tomorrow. Cheers. Bye-bye.